I'm going to record this one. I haven't had a chance to do the executive summary. We had just finished up our planning session, getting ready for tomorrow's live trade. We've got, looks like 4 or 5 guys from this workshop coming to the Kansas City workshop. So we're up around 20 right now. I'm really expecting that to be an awesome experience with a lot of folks coming to talk about their direct experiences with the trading systems and the lessons learned that they've made during the live trades. So I think it's going to have a lot of good value for folks. And we're going to be recording all those sessions, so there's an opportunity for distance learning. If you'd like the workbooks and the videos of the presentations, we're going to be making those available as well to help offset the cost of the conference. So more to follow on that. All right, so this is the weekend report for March 22nd, 2015. We have a market that's in bullish normal conditions on an annual basis using weekly RSI 14. We are the higher end of neutral for at the score of 59 out of 100. Looking back 10 days, the market is slightly overbought using the 10-day NDX at 87 out of 100. Market mosaic price relative to the 200 is yellow bullish at 5.31% with the bulls in charge. ADX is non-trending at 18.0 with the bulls in charge also. The risk index is the 30-period moving average of the VIX divided by the 10. It comes in with a reading rate now of 0.99, which is right at the boundary of risk on and risk off. You take that score of 0.99 and compare it to the last 5,000 trading days and find the standard deviation and the z-score. That gives us the risk z of minus 0.13. This histogram is a 90-day look back of that indicator. You can see that we've rolled down now from 2.0 all the way to just below the 0 line. So we need to be protecting against volatility shocks as the market approaches all-time highs here with the small caps in the lead. It's vulnerable to system shocks. No change in the blended monthly rebalancing holdings from 1 March. Next rebalancing is due next week. And you can see what the current leaders are in each of the different portfolio buckets based on the close on Friday. ETF2, the theoretical exposure increased back up to 90%. The model portfolio itself is at 90%. And again, the Kansas City workshop on 5 through 12 June should be a blast. Moving on. You can see the improvement in the blended monthly rebalancing. Only Latin America remains on a cash signal. Interestingly, we have Japan and real estate at the top of the stack with U.S. small caps in the 3rd position. This is a complete reversal of the trend of about the last 15 months. With the small caps now leading the way over the large caps. Last year that was completely inverted. A lot of healing getting done in the ETF 32, mostly the international postures, and then commodity-based ETFs getting smacked down on the cash position. ETF Max, see biotech still remains at the top. S&P 500 dominated by healthcare, the top 3 positions, Hospira, Biogen, and Boston Scientific. Next up is the market health check. The vertical blue lines represent 10 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels and would act as support levels or price targets on the way down should the support collapse. The purple line is the price target at the all-time high. You can see we're approaching that very closely here in the S&P. Now I compare that to IWM, which made a 1 month, 3 month, and 6 month high and closed it at or near the all-time high. So small caps are slightly advantageous here compared to the large caps. The river is the 30-period Bollinger Band plus or minus 1, the dark blue shaded area in the middle. The lighter blue shaded area is the floodplain, the Bollinger Band 30 plus or minus 2. The pink looking ribbon is the dragon, which is a 10-period regression or a 10-period Bollinger Band plus or minus a half. You can see that it came back to the south side of the river and starting to roll back up, which says there's still some more support for a push through this all-time high here at 211, 212. Price is in the green zone right now, so my directional bias for the daily trade is to the long side. See the market starting to pull away from the 200 period just slightly here. That's a good sign for more health from this bull. On the left-hand side of the chart, you see the slope values of the RL90 and then the thresholds between normal and abnormal. This black sine wave looking line is the actual computed slope value of the market, and the dotted line in the middle is where is the difference between positive and negative slope. The blue circles show where whenever that line crosses the zero line, and also finds some extreme movements at key turning points. This last turning movement here was when the slope value was up around 0.40, which is officially very steep in the S&P based on historical norms. We're getting ready to push out of the river to challenge the this upper limit here at 212, and so if price gets through there, that's going to be very healthy and very favorable to the long side. See, the jaws of PPO have closed to the upside. They're starting to open to the upside. That's a favorable condition. And moving on. This is the ETF2 regional report. We're back up to 90% invested, 10% cash, based on 9 out of the 10 regions being on buy signals. The strongest sectors, Japan and U.S. small caps. Inside the U.S., it's small caps, mid caps, tech, and then large caps. And right now, EFA, the globals, at 51 are doing better than the S&P at 49. So it's also a change in the equity portfolio. Shifting to the daily report, we've got some overreaction short signals here in EPP, Asia less Japan, Latin America, and emerging markets. We've got not many signals, swing signals to choose from. We've got overreaction shorts in DuPont. And the auto framer has a half a dozen or so. DuPont, Cliff Natural Resources, Oil, VIX, Alcoa, and Intel. You see very little to choose from on a swing trade basis, although it's worth noting that Nike has been outperforming on the 1-day, 10-day, 1 month, and then had a nice breakout out of its previous 10-day trading range, being also a big winner on the day on Friday with a return of 3.7%. Home Depot is also another stealthy winner. No signals to speak of, but outperforming across all time frames. Also, not many choices here among the ETFs. We have only oil and the VIX testing out on the auto framer, and then really strong performances turned in by the bottom feeders of Latin America and ILF and Brazil, and silver also good. In the auto framer, it's definitely worth your attention to put the trade frames on Alcoa, Microsoft, Caterpillar, Coke. There's some very interesting posture setting up in all those symbols. And then in the regression line fractal framework, we spent a lot of time going through the theoretical basis for this strategy and how we can use statistics to help us physically and mentally. All right, to be prepared. So some really good work in the preparation for those two. Just going to flash through some slides here. We've got another evening planning session to do tonight, so I'm going to cut this one relatively short, although what I would tell you from the basis of our discussions in the chat room, in the conference room today, there are very interesting trade frames setting up in DuPont, Alcoa, United Health, Home Depot, Walmart, Brazil, and the Russell small caps. So very, very interesting multi-directional trades becoming available in those things. I hope to get some of those published tonight, and we'll hang them in the chat. Other than that, things are going well in Raleigh. Looking forward to getting back home here in a couple of days and working with the chat room with the live traders now tomorrow and on Tuesday. So we hope to see you in the chat room as well as in Kansas City later in the summer. So this is Ken Long from Tortoise Capital. Keep your risk measured and your power drive.